Hey everyone, this is the second of 5 videos where I'm going over various trends that are very important to everyone's portfolio. Last week, you might remember I reviewed how the US stock market has outperformed the international market really for the past 12 years. We looked at that on a long-term basis, an intermediate-term basis, and a short-term basis. And today, we're going to do the same thing, but we're going to go over technology relative to the S&P 500. Okay. Before we dive in, though, one thing I have to remind you is that this is not a recommendation. Okay. So one thing is I'm going to start with the shortest time frame. So this chart goes back to December of 2019. This is a ratio. So how this works is when this line goes up, technology is outperforming the S&P. And what I'm using as a proxy for technology is XLK. And what I'm using for a proxy of the S&P 500 is SPY. When this line goes up, technology is outperforming the S&P. When this line goes down, the S&P is outperforming technology. Okay. So what we see is a pretty steady trend of technology outperforming the S&P 500 until it peaked at the end of August, beginning of September. Ever since then, you see it's really been choppy. You can really see July of 9th of 2020 through January 20th or 22nd, I should say. You see it's been pretty choppy. So let's extend this time frame a little bit. And this is what is called a weekly chart. And this is the chart that I tend to focus on with my clients. And while this chart goes back to 2015, the time frame of this isn't as relevant as it is that this is a weekly chart, but I won't dive into that. So you see this trend is even stronger when we extend the horizon a little bit. So again, pretty consistent since the summer of 2015 up to now. You see technology has been outperforming the United States. And what looked to be a fairly lengthy period of consolidation, you see now is really nothing. Okay. We see a series of higher highs and we see a series of higher lows. Now, this one obviously provided you could argue a lower low, but then its rebound provided a higher high. So this next chart is what I really wanted to show you. One key important thing is that Bespoke Investments came out and stated that technology has never been the top performer 3 years in a row. It was the top performer in 2019. It was the top performer in 2020. So it's never been 3 years in a row the top performer. Does that mean it is not going to be this year? Of course not. Okay. So what you see is that technology's outperformance, which has really been going on since 2006 for the most part, but technology's outperformance relative to the S&P has not been this strong since the tech bubble. Okay, that's important. Now, obviously, the composition of technology is very different today than it was back then. Back then, it was simply euphoria. We had companies that were not making anything in the form of profit, and was doubling, tripling. It was just crazy times. Okay, now technology is outperforming, but for the most part, they're making money. Right, they're a big part of our society, much bigger than they were back in 1999 and 2000. When you look at the fact that technology has been on such a strong run relative to the S&P 500. When you look and see that it hasn't outperformed this strongly since the tech bubble, for me, what I've done recently is I've been overweight technology for most of my clients, certainly the more aggressive clients, but I recently got everyone out. So I'm no longer overweight. What does that mean? Does it mean that I don't own technology? Of course not. Most of the ETFs and funds that my clients own, or many of them, I should say, own technology. It's that I'm no longer overweight technology. Okay. And the reason for that is simply with the belief of a reversion to the mean, as this has been beyond extended, as well as just recognition that there's so much emotion, in my opinion, tied up in technology. So hopefully this finds you well. Next week, I'm going to be going over large cap relative to small cap. Have a great day.